Hello and welcome to Foundations in Accountancy FA2, Maintaining Financial Records. This is chapter number 2, and chapter number 2 looks at the different types of business transactions that we can engage in, and it looks at the type of documentation that we should expect to see if we were to engage in those types of transactions. What we're looking at is recording financial transactions, and we've got two main types of transactions you need to have an awareness of. You need to have an awareness of cash transactions and then also credit transactions. Now, cash transactions is where you engage in a transaction which is a purchase or a sale. So there's money going out if you're going to buy something, money coming in if you're going to sell it. If it's a cash transaction, the money changes hands immediately. So if it's a cash transaction, the money changes hands immediately. And what we say is you can have what's called an OTC, an over-the-counter transaction. So you can have an OTC or an over-the-counter transaction. That's the type of thing that would normally be a cash transaction. These types of cash transactions will tend to be for quite small amounts. You don't tend to go away and buy a brand new car for, say, $10,000 and pay it all in cash. For a credit transaction, what happens is, again, it's a purchase or a sale, but now the transaction tends to be much larger in value and you need to have a different way of paying for it. So it's such a large transaction, you don't just hand over a bundle of used notes. What now happens is we come up with a different way of paying for this type of transaction. And that's the type of thing we're going to be looking at in a little bit more detail when we start looking at things such as receivables and payables. So this can work in both ways. These credit transactions might be a purchase that we haven't paid for yet, or it might be a sale that we haven't received the cash for yet. It's those types of issues you need to have a basic awareness of. Now, the types of transactions you need to have a basic understanding of includes all of the following transactions. And I don't want to sit here and just read through all of these different things. Hopefully you've got a basic understanding of what some of these are. There are a couple which I do want to focus some attention on just to make sure you're happy with it. You have a sale. A sale is when we get rid of an item and we get some cash in for it. So a sale is when we transfer the item to somebody else and then we get the money in. The other side of that transaction is the person who's actually buying the thing from us will be making a purchase or they'll be paying expenses. So we make a sale, the other person has a purchase or is paying expenses, and we're going to focus in on the difference between purchases and expenses in a little bit of detail in just a second. You've also then got payroll, which is an amount of money that you're going to be paying out, because we're looking at this from the business's perspective, not the employee's perspective. And then we also have to have a basic understanding of the difference between a receipts and payments transaction. So cash is actually happening. So cash is being transferred within a receipts and payments transaction. And then also if there's not cash being transferred, you still have to record it. So the cash is a cash receipt or a cash payment that has to be recorded. Even if there's no cash being transacted, there still may be a transaction we have to record. And again, we'll look at this in more detail when we look at the sales part of our ledgers, and we also look at the purchases and expenses parts of our ledgers. So we will look at that in more detail. What we also have is this idea of a sale. And one of the things I really want to focus a little bit of attention on here is the fact that if we are selling something to somebody else, we sell it, that's our sale. The other person then purchases that thing. So we're selling it, the other person then purchases that thing, or they've actually paid an expense. Now, the purchases and expenses are very, very subtly, but very definitely and importantly different from each other. So what I want to do now is focus in on the difference between purchases and expenses. Now, what we have is a purchase is an amount of money that we're either paying out now or we guarantee to pay out in the future, depending upon whether it's a cash or a credit transaction. So purchase is something which is going to cost us some money, but the thing that we've acquired can now be resold to somebody else. So a purchase becomes something that I'm going to sell on to somebody else. That purchase will form part of my cost of sales. And just put a little love note on your notes there, guys. So purchases becomes part of your cost of sales. That has an impact on your gross profit. When we start looking at chapter 2, this will make a lot more sense. So purchases have an impact on your cost of sales, which will impact upon your gross profit. An expense is something that you've incurred, it's something that you've used up, such as electricity, or maybe some heating, or maybe some lighting expenses. So it's something that you've consumed that you then have to pay for, and that thing that you've consumed will still be shown as part of your profit and loss. However, this type of expense is not part of your cost of sales. It's a different type of other expenses. Now, these other expenses will have an impact on, and this is important, these other expenses will have an impact on your operating profit, but they will not have an impact on your gross profit. So put a pin in that and make sure you pull this back when you're looking at chapter number 2. Because in chapter number 2, we're going to look at the profit and loss account, the income and expenditure account in a little bit more detail. And I'll actually focus some time and attention on the difference between purchases and expenses in chapter number 2 as well. So make sure you're happy with that, please, guys, after you've gone through chapter number 2. Now, carrying on with chapter number 1, the next thing we need to look at is the difference between receipts, which is money coming in, and that will be potentially because we've made a sale. That sale will be an income figure. So the sales that we make, generate income. That income actually shows itself, it manifests itself, so it actually occurs as a receipt. So the sale, which is an income figure, becomes a receipt of cash sometime in the future. A payment will then become a purchase or an expense. So money going out of the business will become a purchase or an expense. So money going out of the business becomes a purchase or an expense. Now remember, there's a difference between purchases and expenses, and we've looked at it a little bit. We're going to look at it again in chapter number 2. Every single time we engage in any type of business transaction, you need to make sure that you keep a record of everything which is going on. Now, there are various different reasons why you must keep a record of everything which is going on. Some of the reasons, and this is not an exhaustive list, but some of the reasons why you should keep a record of everything which is going on starts with, first and foremost, you need to make sure you know what type of transactions you've engaged in, so you know how much you owe to your suppliers. So I need to understand how much purchases I've made, and potentially not yet paid for. So I need a record of credit transactions, but I haven't paid for them yet. So I know how much I need to pay out in the future. I also need to make sure that if I make a sale, which means I should get a receipt of cash at some point, I need to make sure that if that is not a cash transaction, so it's a credit transaction, I need to make sure I know how much people owe me. In addition to that, these type of records can be used as a means of resolution to any type of dispute. So these type of business records can be used as a resolution to any type of dispute with the people I owe money to or the people that owe me money. Also, it will make sure that my accounting records are complete. So I'll ensure that my accounting records are complete and put a little love note in brackets after this, and ensure that there's no fraud taking place. So it ensures that my accounting records are complete and that no fraud can take place. It also allows me to monitor performance, but performance of my business in terms of profits and losses can only be monitored if I know with certainty that the accounting records are complete. So those two things tie in quite nicely. I also need to make sure that I keep my staff happy, because staff are the most important part of any organisation. And I need to keep my staff happy by paying them the right amounts. So I need to make sure I pay them the right amounts and that I pay them at the right time. These business records will make sure that I'm doing that. So these business records will make sure that I'm doing that. Now, the types of documents that I can have to ensure that these records can be completed appropriately can include things such as we've got various different contracts, we can have quotes, we can have payments, we have lots of various different documents potentially here. And we're going to come to what the different documents are in just a second. But the reason why I need these documents ties in very nicely into why we need to have business records. So the reason behind business records and the reason behind having business documents are very, very similar. They're not exactly the same, but they're very, very similar. So I can guarantee that certain things have happened. So there's the evidence for the transactions. If it's a larger transaction which has taken place over a period of time, this will now tell me exactly where we're up to within that transaction. So I now know what needs to happen from my end to make sure the transaction now becomes complete. It can also be used as a check and a confirmation afterwards, which means that there's no fraud, and I can ensure that my accounting records are updated and correctly state everything which has happened. That can be really important to me. Now, the types of documents we can have, and again, I don't want to just sit here and reel off all of these various different types of documents which are available. There are certain things here which are really important to me. A quotation is given before the job starts. The order form comes from somebody who's actually placing an order. You've also then got a delivery note, which is when I deliver the stuff, so deliver my goods to somebody else. That'll then become a goods received note from the other party. We've got an invoice which says that I've sold some stuff to you. Here's the invoice which shows you how much you owe me for that one transaction. The statement summarizes all of the invoices over a period of time and all of the cash payments. So the invoice tells me what's happened for a single transaction. The statement tells me what's happened over a period of time and will include usually several invoices. We then have a remittance advice or receipt. We then have a credit note and a debit note. All of those things will have an impact on the amount I owe somebody or how much they owe me. All of those things will be included within the statement. We then have petty cash vouchers, which we're going to look at in more detail in just a second. And then we have check requisition forms, which we'll come to when we get to the end of this chapter. We talk about various different types of payment methods. And then the payslip details exactly how much is being paid to my employee and how much is being deducted because they have a tax liability, and how much is being paid over on their behalf as tax, and how much is being paid over on my behalf as an employer to pay some of their tax as well. So there's a lot of tax issues going on there. Now, all of these documents can be used to identify certain parts of a transaction. So what we now have is a very detailed process, which is a complicated and complex transaction, which will take place in various different steps. These business documents will allow me to see and allow me to evidence that we've gone up to a certain point and maybe potentially beyond it. So the quotation says, I would like to perform this level of work for you. Then the order comes in from the client, and that now means that they are happy with the quotation. So I send the quotation first. The client then comes back and says, we're happy with that. Here's my order. We then have the goods delivery note, which is the stuff actually appearing at the clients. And then there's the invoice saying, this is how much you owe me. Then the statement says, here's a summary of everything which has happened over a period of time. So there's a very, very simple set of transactions with bits of paper, bits of documentation, evidencing everything at every step. Absolutely essential. When you come to your MA1 and MA2 papers, we go through this in a lot more detail. So this is something to give you an introduction to it. You go into it in more detail on the MA1 and MA2 papers. Now, I did say we were going to look at petty cash transactions in a little bit more detail. And what we have within the petty cash transaction system is only small value cash transactions. And they tend to be cash purchases. So if you need to go and buy some milk to have a cup of tea, if you need to buy some biscuits to make sure you can have something to eat with your cup of tea, then that will be a small value transaction that will normally be paid for from petty cash. What will happen is, as you take money out of petty cash, you will complete a petty cash claim voucher. At the end of the month, the value of all the petty cash claim vouchers plus whatever cash is in the petty cash tin should total the amount that was put into petty cash at the beginning of the month. Now let me just restate that. If you have a situation whereby we put a float of say $200 into the petty cash tin, then what happens is I decide to take $10 out to go and buy some biscuits. I will now complete a petty cash voucher which says I've taken out $10 to buy some biscuits. That petty cash voucher will then have my invoice or my till receipt saying I've spent $10 on this, to say there's the $10 being spent. At the end of the month, we've now got $190 left in it and a voucher for $10. That now allows for the petty cash system to be reconciled every single month to make sure that there's no fraud, there's no theft. It also allows me to work out how much extra money needs to be taken from the bank account and put back into petty cash. And what I do is I add up all the petty cash claim vouchers and I say the total of vouchers are $10, therefore I need to transfer $10 from the bank account back into petty cash. That's known as part of the imprest system. I-M-P-R-E-S-T, imprest. And what that means is petty cash will always have $200 in it. So that's the wonderful system, nice simple system. Most firms will use that. It just means that I've got vouchers instead of cash, but they have a cash equivalent value. And at the end of the month, I will transfer that amount of money from the bank account back into the petty cash system. Now, other things we need to have an awareness of: payroll documentation. What type of information should be held on a payslip? Well, you should have things such as the name, potentially the employee reference number. There will be a unique tax reference number, which might be a national insurance number or social security number, and it'll be the amount of gross pay, the amount of tax deducted, and then the amount of net pay. So there's quite a lot of information on this payslip. What I would suggest you do, guys, is have a look at your next payslip and just look at the amount of detailed information on there. It can be quite significant, and you do need to have a basic awareness of all of that. Now, with all of these different types of business documents, why do we bother to have them? We need to have them so we can confirm exactly what type of transactions have happened in the past, so we can make sure our accounting records are up to date, to make sure that we can resolve any type of disputes with any of our business partners, our suppliers, our customers. We need to make sure we know exactly what's going on. You may find, depending upon your domestic jurisdiction, so the country you live in, that there is a specific time period you must keep these records for. As a general rule of thumb, you tend to find that businesses have a legal obligation to keep these documents for a period of at least 6 years. 6 years. The date on the documents, so the date on the documents and the time that the documents are processed, will influence which accounting period the transaction falls within, which means that there might be some sort of VAT or a sales tax issue in there. There may also be some sort of corporation tax or an income tax issue with regard to the business who's actually transacting these transactions. So it is absolutely critical that the date on these documents are looked at in some detail to make sure you process them within the correct accounting periods. Now, we've been talking about cash transactions and also credit transactions. If you've got a cash transaction, that type of cash transaction will include over-the-counter, OTC. So that will include over-the-counter, OTC sales. It would also potentially include check sales. So this is where people write down bits and pieces of information on a piece of paper and then say that the bank will make a transfer to you. Checks aren't very, very popular anymore. We don't tend to use them very much. What we will tend to use instead is debit and credit cards. The debit and credit card will allow funds to be transferred from one party to another almost immediately. So the debit and credit cards allows for transfers, not quite as quickly as cash, because as soon as you get the cash, it's your money, but the debit and credit card will normally allow for the transfer to occur almost instantaneously. If there are larger amounts which need to be paid, you may find that a credit card or a debit card is not the best way to do it. What you may now find is you use BACS or CHAPS. Now, BACS is the bank's automated clearance system, and what happens with a BACS payment is you transfer money from your account to somebody else's account. BACS tends to be low cost. However, it also tends to only be used for very small transactions. If you've got a transaction in excess of $10,000, you may find you'll be expected to use CHAPS, which is the Clearinghouse Automated Payment System. So Clearinghouse Automated Payment System. CHAPS has got a cost associated with it, but the transaction occurs very quickly, usually instantaneously. So it's an immediate transfer. BACS can take up to 5 working days. So CHAPS is immediate, use it for bigger transfers. BACS, not immediate, use it for smaller transfers. You can also have standing orders and direct debits, which allows money to go directly from your bank account to somebody else, which allows for immediate payment of amounts. These type of standing orders and direct debits are usually used to pay off expenses rather than purchases. So these will usually be used for expenses rather than purchases. So it might be the electricity bill being paid off every month. Now, There are a couple of legal issues you need to have a very brief awareness of, and there's two things I need to talk to you about within this chapter. First and foremost, contracts, and then second of all, data protection issues. You do not need to have a huge in-depth knowledge of either of these. You just need to have a basic understanding of them. Now, from a contract perspective, the contract is how we engage in transactions with other parties. The contract will have terms and conditions, which tend to get shortened down to T&Cs. So the contract will have terms and conditions, or T&Cs, that will detail exactly what has to happen from both persons, both parties. That tells me that if I'm going to sell some stuff to somebody for $100, it says that the terms and conditions will say that I have to give you this item, you have to give me $100. Contracts have got different component parts. They're called conditions and warranties. Now, a condition is something which goes to the heart of the contract. It is absolutely essential that the condition be fulfilled for the contract to be completed. When we say a contract is completed, we say it's satisfied. If you're not satisfied, so if the condition is not fulfilled, then you can take action. That action may include legal action. So you may be able to take some action in the courts to get some sort of compensation. We call that a remedy. That's as far as you need to go with the legal terminology. With a warranty, this is something which should be done, but if you didn't do it, then the contract can still be completed, it can still be satisfied. However, if I'm not happy with the way it's been satisfied, I can now take action for, again, more damages, a remedy under court action. So I can take action against you and look for a legal remedy, which will be some sort of cash compensation. That's it with regard to the contract side of things. With regard to data protection issues, which is the second legal issue, the main objectives of any data protection regime, and I'm not looking at one individually, it's any data protection regime, so any data protection act anywhere in the world, will be to make sure that individuals are protected from businesses processing their data incorrectly, from businesses holding their data for too long, or from businesses holding incorrect data. So all of these data protection issues are all about protecting the individual from the business. It's all about protecting the individual from the business. And to make sure that this works, there are certain codes that tend to be applied in almost every single data protection legislation, which will include things that protect persons from the business. So we're always looking to protect persons from the business. As for instance, the business is only allowed to hold your data for specified purposes for a specific period, and if it's now fulfilled that obligation, you are now not allowed to keep hold of that data. You must now destroy it. And you must destroy it in such a way that it can't now be regained by anybody else. You must protect it to make sure that it can't be stolen from anybody by somebody else. So there's a fraud issue in there as well. There are certain things which are outside the scope for data protection issues, and the general rules of thumb are, if you hold information on individuals for payroll purposes, that's fine. If you hold information on purpose on individuals for the purpose of maintaining your accounting records, that tends to be fine as well. As an aside, if you hold details of individuals for exam purposes, that's usually outside the scope as well. That brings us up to the end of chapter number 2. Thank you very much for your time and attention, guys, and I will see you all bright-eyed and bushy-tailed on chapter number 3.